Welcome back. You're watching Markets at Noon, and let's now try to gauge the trend of the markets amid volatility. No matter how much uncertainty we see from the global front, but there are many tailwinds which will help the domestic markets. And to discuss the same on a larger picture, we have Mr. Krishnan. We are Chief of Quantitative Research Team at Marcellus. Mr. Krishnan, good afternoon. Thank you so much for giving your time to ET Now. Mansi this side. It's a pleasure talking to you.
Thank you, Mansi.
Yeah.
Good afternoon to you.
Yeah. So to start with, a lot of uncertainties and contingent scenarios on the global front, but at the same time, the domestic markets are maturely trying to face them all. How should investors, according to you, position themselves in context of current macroeconomic condition characterized by surplus liquidity, easing monetary policy, lower commodity prices, and all in all, what's all happening on the markets?
Sure. So, for starters, the corporate earnings growth in India, is going to become scarcer, like going forward, right? So if you look at the nominal, GDP growth, that's basically if you just think about it broadly, it's the real GDP growth, which is forecasted to be around 6.5%. And then the inflation, right, which has also come down to 3.5-4% now. If you just look at the last month's CPI reading, right? So even if you add a couple of percentage point here and there, right, in a very best case scenario, also I don't think at an aggregate level you would expect corporate earnings growth to be more than 12-13%. And given that a lot of corporates in India today are not as levered as they were, say, even 5 years back. Actually, the corporate leverage has gone down, right? So the bottom line, earnings, right? They should not, again, there shouldn't be much difference between the revenue growth and the bottom line EPS growth, right? At least at a aggregate level. So as a result, we think that earnings growth is going to or companies which are going to deliver earnings growth in this environment are going to fetch a premium and which is to be expected. And investors in this kind of backdrop, right, should be more selective firstly, secondly be more valuation aware, both relative as well as on an absolute basis. And be more, focus more on fundamentals rather than themes, right? So, within this, again, we have, if you just think about it tactically, within sectors, obviously, given what RBI has done recently, the last monetary policy, they cut the CRR by 100 basis points and, the repo rate by 50 basis points. So both of those actions are actually somewhat of a positive, I would say, for at least for companies which provide fixed rate loans, right? So because your loans, those loans will not get repriced immediately down to a lower rate, but your funding, right, or your liabilities, right, those will get repriced faster, right? So your cost of funding will come down, whereas your loans would still be at an older, higher rate, right? So, which can help the net interest margin for at least for vehicle financiers, etc., which mostly offer fixed rate loans, right? And also remember that over the last 1 year, the yield curve as such is also steepened, right? So it's steepened by 100 basis point versus where it was almost flat.
Right.
When you compare it what it was,
Right.
start of
So
the year or
clearly,
last
lot of action on the domestic front and lot of optimism and positivity on the domestic front. Hi, Mr. Krishnan. This is Kavita, and having you on board is a recipe to have a robust long-term portfolio. Now, I really would want to take a piece from your research as far as your sector-specific approach is concerned. You really mentioned few ramifications that we might look at, but then fundamentals need to be strong. Now, having said that, looking at the current US FDA mini deal and looking at sector-specific dent that we are seeing in the market right now. Is it the right time for someone to maybe reallocate or rebalance their portfolio in terms of sector-specific approach? How are you looking at these short-term knee-jerk reaction that we are looking at on the companies, on sectors as well? Do you think this is the time for someone having a long-term portfolio, and not very long term, I'm talking about maybe 2-3 quarters? What would be your strategy?
Sure. So, I think on the tariff related, I would say, headlines which we see almost every day. So there are, if you, for example, take an example of IT sector, right? It's down, somewhere around 9%, till, the first half of this year. Versus Nifty, which is up 8%, right? So that's been the the degree of derating we have seen, right, due to the negative sentiment, I believe, at least partly due to a fear of US recession, right, or US economic slowdown. But if you actually see the the economic data coming out from US, whether it's May or last month, the economic data is actually surprised on the positive. Right. So last week we saw, for example, the payrolls data, which was actually better, if my reading is right, compared to same time last year. Right. So some of the, the bear case scenario, right, on US economic slowdown or US recession, that hasn't, at least that doesn't seem to be coming out in hard economic data. So if we, keep that in our mind and we look at, the performance of IT stocks, right, which have, it seemed to have re-rated partly due to, some of these fears. So there could be a case, right, where, some of the, at least some of the derating can be clawed back. Fundamentally, we don't see any triggers because most large cap IT stocks, they still, deliver close to, mid-single digit or high single digit returns, revenue growth. So it's not, I don't think, there's any case from a fundamental point of view, more from, the negative sentiment, right, which doesn't seem to be panning out in terms of the hard economic data, from coming out from US, right? And then, for example, some sectors like pharma, right, where obviously there are very real tariff-related concerns. Even yesterday we saw some news flow, coming out from US. So even there, right, I think, if you take a more long-term view, and if you look at some of the
right, as we expect tariff details to emerge, because there is more confusion than clarity in the current state of affairs. You mentioned about IT and pharma, but I want to understand from you regarding the confusion which is there in the minds of someone who wants to invest currently. We have seen that there is a style of investing which everybody does it differently. Whether one should go for some quality kind of stocks, as you were mentioning about large caps, or should pay attention to low PE. You have mentioned earlier that low PE stocks have done better after COVID. So what is the strategy one should adopt right now?
Yeah, so I think going forward, if you look at how things have, if you take a longer term view, right? So we published a study, last month, where we looked at, the relative performance of, cyclical or, value stocks like the low P stocks, which you said, versus quality or defensive style of investing, right? So we looked at a 20-year period of, performance of, hypothetical portfolios, quality portfolio versus a value kind of portfolio. And what we found is if you just look at period to period return, right, over the last 20 years, the performance has been broadly similar. But what happens is there are brief periods of time, like 5-10 years, right, where one style typically does far better than the other. So, for example, just before, the Lehman crisis, 2002 to the Lehman crisis, value stocks did really well, right? And then post the Lehman crisis, quality has done very well till COVID, right? After COVID, again, cyclical stocks have done better. Different reasons, because obviously when you look at the last 5 years, right, government capex has been really strong. And then obviously a lot of these stocks had substantially derated, going into COVID or just in COVID as such. So because there was COVID related lockdown, etc., which affected these sectors or these kind of stocks more. So as a result, these stocks did really well over the last 5 years. They've beaten a defensive quality kind of portfolio hands down, right? But if you look at the economic backdrop, going forward, which is, where you see government capex slowing down, inflation also trending down.
Agreed.
One would, I would say that, the environment is more conducive to a quality defensive, style of investing again, versus, the cyclical stocks which have done better over the last 5 years.
Absolutely, absolutely, Mr. Krishnan. Thank you so much for that take. It was really insightful. Thanks for giving your analysis to us.